Hello, I'm Alex Davies, founder of Wealth Club. Today we're discussing venture capital trusts, what they do for individual investors, small businesses and the UK economy. Venture capital trusts, VCTs for short, are investment companies listed on the London Stock Exchange. They've been around since 1995 and provide a way for experienced investors to get exposure to a portfolio of young, often privately owned companies that meet the VCT criteria set out by the government. Because these smaller businesses are higher risk, VCTs come with tax benefits such as up to 30% income tax relief and tax-free dividends. Successful VCT-backed companies include Zoopla, the property search app, Plenish, the plant-based drinks brand, and pre-owned fashion marketplace Depop, to name but a few. The last couple of years has been a challenging time for venture investing, with interest rates and high inflation causing drops in valuations and dampening investment appetite. That said, in the most recent tax year, VCTs still managed to raise an impressive £882 million, down on the previous 2 years, but significantly ahead of the wider venture market. So what does the future hold for VCTs? Are we at the bottom of the market? Is the bad news out of the way? How have VCT investee companies coped with a downturn, or have they actually seen a downturn at all? With green shoots appearing in the economy, a new government and an extension of the VCT scheme confirmed until 2035, could this be a perfect time to invest? Joining us today to discuss this are three respected and long-standing VCT managers: Chris Lewis of Pembroke VCT, the current chair of the Venture Capital Trust Association, Seb Wallace of Triple Point Venture VCT, and Paul Davidson of Octopus Ventures, manager of Octopus Apollo VCT. It's been a funny old 2.5 years for the economy and venture investing in general. What's it meant for VCTs? I'll start with you, Chris.
Thanks, Alex. I think VCTs have had a difficult time for the last 2 or 3 years, but in the wider context of venture capital in the UK and overseas, it's actually outperformed. The valuations have remained broadly stable, and as you said earlier, there's been 3 record years of fundraising into VCTs in the UK.
And have you got anything to add to that, Seb?
No, it's an interesting point. I think what Chris says at macro level is right. In 2020 and 2021, we expected the market to dampen because of obviously COVID and obviously the upending of the economy. But then looking back with hindsight, the significant amounts of stimulus meant that it was a relatively benign environment. Actually, what happened, the correction really happened when interest rates went up in 2022. And our VCT, and actually lots of VCTs, probably everyone's VCT in the market, saw corrections from some of the frothy valuations, which is by and large healthy, I think. Since then, broadly, it's been relatively stable. It hasn't been a situation of significant valuation growth by stage, but really the correction sort of settling. I think we're in a reasonably settled place now. There's good money in VCTs to invest. There's still a lot of money in our non-VCT peers that we all compete against for funding companies, which is keeping valuations for good businesses still quite high. But rarely, relatively speaking, I'd say the market has balanced out a bit, and we'd expect to see the current conditions remain for at least the next year or two.
And Paul, is that the same experience? Have you had many down valuations within your own portfolios, and what are the companies you invest in? What are they saying?
Yeah, look, I think the broader market has seen some pressure on valuations, and I think our portfolio across a number of VCTs are not immune to that. I think the biggest change has probably been the mindset with which VCT investors actually invest in these companies and how these companies are managed. So I think if you look back to 2 years ago, businesses were raising a lot more money and trying to invest that money very quickly to maintain very high growth rates. I think over the last 2 years, they have tried to stabilize what they've already got. And the companies are probably managing themselves in a much more sustainable kind of long-term mindset of, let's not raise too much money if we don't have opportunities to deploy it. So I think for the VCT managers themselves, they probably spent a lot of time working with those businesses, getting them to think about how they grow their companies in a sustainable way for the long term.
And Chris, is that something you're experiencing with? How have you been dealing with your companies?
Well, I agree with that. The companies are being more efficient with the cash that they get funded with. I think the investment managers are being more efficient with the amounts of money that they put into the companies. The whole VC and also private equity space in the last 2 or 3 years has been holding on to cash to look after its own portfolio companies. I think that's starting to unwind now. The clouds of the economic backdrop are moving away, and I think the future is looking a bit brighter. We've seen a lot more interest in some of our portfolio companies from trade and from private equity, and I think there's some recent exits in the industry that are showing that there's a bit more focus coming back to investing into the portfolio companies that we collectively have invested in.
And have you seen more companies going bust over the last couple of years?
I think yes, but equally, companies are becoming much stronger at extending their own cash runway. They're getting more discerning about how they spend money, and that's a good thing. Often when we put money into a company, the business plan suggests that there'll be an immediate improvement. Often that's not the case. It takes 6 to 12 months to see a sustained improvement in revenue, and not just spending money on marketing to buy a blip in sales. Companies are now focusing on the long-term steady growth that's repeatable, but also focusing on the underlying business model that shows that profits or losses are reducing and they're moving towards profitability. So profitable growth.
I kind of feel like, just picking up on that point, I feel like you're forged in fire a bit more now as a founder. Like, the idea that there's money sitting there if you can keep up a top line level of growth has been relatively rote fact for many founders for probably the period from 2014, even through Brexit, up to about 2021, 22. Really the zero interest rate policy, the ZIRP era. We come out the back of that. Now founders are forced, as you say, Chris, we've both been talking about it, we've all been talking about it, they've been forced now to cost control a little bit better and to really look at their unit economics and their margins and their efficiencies. This isn't particularly groundbreaking stuff for a manager. As an investor, this is what you're thinking about. You obviously are also thinking about growth. But founders have to both run their businesses and react to what investors are expecting. And later stage investors were perhaps a little bit more relaxed with some of the metrics around margins and efficiency if you could show top line growth. And that has now shifted. It's a healthier place to be, in my view. If you look back in 2008-9, which was the last real proper correction, that market saw phenomenal businesses built and grown, like whether it's Slack or whether it's Uber, just two. But bad markets do make for much more discerning and resilient founders who understand what the core things that are required to build a business are. And I think that's what we're seeing now. And some of those changes and learnings happen within your portfolio, and those businesses do well. And the founders that don't learn this stuff go bust, as you say.
I agree with you completely. The last 6 or 7 years we've been through, or the companies we're seeing now as opportunities, whether for new investment or follow-on, that have come through Brexit, maybe so founded post-Brexit.
Yeah.
They've had COVID-1, COVID-2.
Yeah.
Then they've had increase in the number of global wars. They've had increases in inflation. They've had supply chain issues.
And interest rates.
And through all of this, they're still coming to us with fantastic trajectories and business models that are fit for purpose and are just looking for funding nowadays. And these are great businesses that have been resilient for the last 5 or 6 years. And imagine what they can do when the clouds start to move away.
I think the market's bifurcating, though. The good founders who've learned this, there is still money for them. And in fact, there's actually a lot of money for them. And the markets and the valuations are still reasonably high. And the growth trajectory and optimism is also high. And so it's not necessarily a bad situation that the valuations are high. But anybody who is not learning or doesn't have the quality, there is very little room for maneuver now. And that can mean sometimes managing portfolio companies who are going to get there, who haven't quite learned or are learning slower. But for the businesses that are doing well, you can see them really pull away quicker. I wonder whether that's going to be just the norm from now onwards. It's hard to know, given we're in a new interest rate environment. It's like asking the same question in 2011. We're not quite sure what it would be like, but it certainly feels a bit healthier now. I don't know what you think, Paul.
I think the only thing I would add is, being a VCT manager, you really have the ability to look long term. And sometimes, particularly as you're backing earlier stage companies, they may be great businesses, they may have great teams, but it might not be the greatest time for them to grow. And because we do have that long-term outlook, we are able to invest for the long term, which hopefully benefits these companies when the market does come back in their favor. So hopefully as interest rates are decreasing, inflation is becoming more under control, we've got more stability in the government, this may be a great time for these businesses to keep growing again.
And are you finding better opportunities than you were, say, 3 years ago?
I think, to kind of touch upon what Seb said, I think you are seeing opportunity flow come back. So there are more companies that are now in a position where they want to raise again. I think the majority are maybe not growing as fast as they were 2 or 3 years ago. I also think what is an exciting kind of growth rate for a business has also changed a little bit. That's where the investor mindset has also changed. So we are seeing opportunities come back. I think we're definitely seeing more than we saw 12 months ago. It's quite hard to compare it to 3 or 4 years ago because I think at that time there were so many companies raising money and possibly some companies that shouldn't have raised money. Right now, I think the businesses that are fundraising today are good companies. They've got the right approach and outlook on how they want to grow their businesses. And also the investors that are in the market right now are thinking about those companies in the right way.
And just to pick up on one point you said there, when you talked about the growth rates being, slightly lower was what the inference was than what they were before. It's not like they're worse. The quid pro quo is the margin profile is better.
Or they're being more effective with their cash management.
Yeah.
And they're being more discerning about how they spend the money. Because we all know that money is only one part of the equation.
Yeah.
They need mentoring from the people in our offices to make sure their model matches the market. And it's trying to align everything all at once. Yeah. And as soon as you put the money in, usually all the planets come out of alignment again. And as you prepare for the next funding round, you have to bring them all back in again, the market, the model, and the management team, and finally put the money in. And we're finding that they're doing probably smaller rounds, less ambitious in terms of valuations because there wasn't that much appetite. But I think founders are now becoming more discerning and aware of that need to show a gradual improvement in one's valuation and not just go from down here to all the way up here because they risk not delivering on their promises and having a down round afterwards. So we're seeing
or not being able to raise afterwards.
Conservative approach to valuations and spend.
Yeah, I think that's right. The one thing that I think is a real step change that's happened, frankly, over the time, we were all talking about how long we've been doing this over the last decade or so, that has changed materially and probably isn't going to go back, and you'll have found this as a founder, Alex, as well, is that there is just a fundamental acceptance in the British psyche of working for a startup, starting a business. Like, if you do that and it doesn't work out, it's not a blip, it's not like a gap in your CV, it's actually credible experience. Like, that was not the case in 2006, 7, 8. Like, the market has changed, and the mentality of how Britons see entrepreneurship has fundamentally shifted in the last 12, 13, 14 years. That remains the same. So I think that's like a core foundation when I think about teams and efficiency. One thing that was coming to my mind was, can these businesses still hire great people? Because that's what they've got to do. Yes, they can, because people are still willing to take a risk with a loss-making business or a fast-growth business in a way that they weren't 15 or 20 years ago. And that's still a macro positive, even though we've seen this correction that I think is a fundamental shift that will hopefully remain. I've seen it remaining. I don't know what you guys think.
I think it's a good time to be an entrepreneur at the moment. It's always difficult, but it's never been easier. Everything's in the cloud. You don't have to have an office. What we're seeing is a greater number of people come out of larger organizations having a deep knowledge of what the underlying industry issue is that they're not able to fix in their company, or they think that they can provide a better solution outside, get funding, and we're finding people in the middle of their careers becoming entrepreneurs. And those people have a deep understanding of what the problem and the solution is, and that's what we look for.
Very interesting. And there's 3 of you from 3 different companies. Are you competing all the time for deals, or has that got easier too? Because certainly 3 years ago, everyone was competing for the same thing.
We're all very differentiated.
We all see
each
other's. The certain deals come to the market. And all of us may see all of them. Actually, on some deals, they won't take a venture capital trust market.
Our niche, like the differences in our strategies mean that some deals we see together, and others, you see stuff that we don't.
Sometimes we compete, and sometimes we partner.
Yeah.
At the end of the day.
Yeah.
Sometimes we sit on.
There is any opportunity which is coming to the market that is VC-teeable.
Yeah.
If we can use that phrase, it's generally. we're kind of always interacting on these opportunities. Maybe you've invested earlier than we've invested, but we are trying to partner and ultimately look at how we can grow these companies either together or if it's standalone, then
it's
fair enough.
uniquely in our group here, us three, we don't compete as much because we're different stages, generally speaking, into when we invest. We're very, very early, often before these guys, although we have invested alongside Pembroke in deal and alongside Titan, but not alongside Apollo. But then you guys are almost like the stage after and the stage after that, so it kind of works quite well.
Business nowadays, even with inflation, just takes more money than it did before. And so the bigger the round, the more comfort there is from for the investor's perspective that to have an investor alongside us at each funding round, and that's very important, which means that there might be 2 or 3 of us at each funding round, and that allows us to provide more advice and more mentoring to the local management teams, which is the other side of just providing the money.
And networks for introducing to VCs at later stages. We all just share that.
Right. I mean, I think, Seb, your point is a good one around us all having slightly different stages that we invest in. But I think that's the key to having a really healthy ecosystem here in the UK is you have pots and pools of capital at each stage that is supporting a founder or a company on its journey, so that there is enough opportunity for investors like us to also invest in companies at the later stage, but there is enough opportunities and entrepreneurs getting a chance at the earlier stage. So I think that is a real key factor to having a functioning ecosystem, is having those pots of capital at each stage.
I think there's competition, but it's healthy and collegiate.
Good. And from an investor's point of view, obviously, there was, for a while, it seemed anyone could build a £1 billion business, but it turns out it's a lot harder to actually do that and sustain it. Is all that sort of froth out of the market now? Is there still likely to be of a downward trend in VCT NAVs, or is that washed out now, would you say?
I think the VCT NAVs have, on the whole, with the total return by the time we add back the dividends, have tracked sideways for the last 3 or 4 years, and they've had all the challenges we've talked about. But looking forward, I think the weather is getting better. Inflation is down, interest rates are trending downwards. I think the government support to the extension for another 10 years to VCTs and EIS just recently is an indicator that they're going to continue supporting the VCT space, and that we will have the opportunity to continue doing what we're doing. And on the back of 3 years of record fundraising, I'm optimistic that we're going to continue being able to raise money to invest in these companies.
And for all 3 of you, what's a good exit look like? What type of companies are you trying to build? What sort of enterprise value? What is England, Britain, UK
good at, right?
Yeah, what are we good at? What's our hotspot?
Yeah, I was going to actually almost answer that in your last question, because it's sort of like, is £1 billion where you want to go, or $1 billion is, I think, the technical definition of a unicorn. The reality is you can do that in the UK. You can do that with tech, but it probably is tech-enabled services where you can capture more of the margin than pure software. But generally speaking, a tech business that wants to deliver that sort of outcome needs to expand internationally, and almost always, not always, but almost always expand into the US, because it's a large homogenous market with the same language. If I look at our portfolio and our businesses that have got to like those 9-figure valuations, like there is a very clear trend in B2B that the US is a market you want to tackle. The UK's phenomenally innovative and actually a great market to start in, but you probably need to expand eventually. I still think we would want the £1 billion outcomes with each deal that we're investing in at seed stage, at least to be able to underwrite that that's possible. It will be with international expansion. Realistically, and one of the things I say when I'm on the road is we're optimists but statistical realists. In the UK, 60% of businesses exit for an EV of £50 million or less. And going early helps for that, because it means that you can get a decent return even without later stage investors if they don't get involved, by going slightly earlier. But I do think that a good outcome in the UK can be measured in 9-figure numbers. Certainly, if you look at Onfido, which exited recently, you've had Credit Kudos that sold to Apple, and a whole host of other businesses in a similar space. Those are good outcomes for VCTs, certainly. They're good outcomes. But it is possible to do the £1 billion. It's just, statistically, it's anomalous, but we're in it for the anomalies.
I think my provocative comment would be, if you're waiting for a unicorn, you could be waiting for some time, or you could be waiting a while. But I think it depends where you invest, which stage you come in at. So I think for the really early investors in the ecosystem, you absolutely need to be looking at 25, maybe 50 times return on capital invested. We invest slightly later, so we're not necessarily looking for those types of outcomes. We may be looking for a single-digit return on the capital that we've invested, and that may still require you to get into the hundreds of millions of pounds for an exit, but we may not still need a kind of $1 billion exit.
I agree with that. Sort of 5 to 15 sweet spot in terms of exit multiples is what we should all be aiming for first. If you get to $1 billion, great, but before you get to $1 billion, you have to be at $500 million. And before that, you need to be at 50 million. So just focus on the next stage is what we tell our investors and our portfolio companies. And eventually, if they keep on doing what they intended to, they've got the right strategy and the right execution, it may come. But invariably, those businesses require a lot of funding and often more than what the VCTs can offer.
And legally can provide because of the gross assets test. Yeah.
Gross assets tests, annual investment limits, lifetime limits. Age limits as well are often quite a challenge. The gross asset test is particularly important for traditional manufacturing type industries. All of these are being worked on or discussed with Treasury by the VCT Association on how we can make small but important changes to the scheme.
This is so we can follow on into our winners effectively, is that the thinking?
Effectively, yes. And also we need to remove some of the historical rules. Because the rules have changed every 5 to 10 years, no one's actually gone back to have a clean out of the old rules. And some of them are no longer really fit for purpose. But we have to work with Treasury, and maybe we've seen with the EC, in order to get their approvals to making changes to these. So it's quite a long, drawn-out process, but I'm confident that over time we'll be able to make some tweaks to the system that will allow VCTs to go from a good little system to a fantastic scheme.
So Chris, without going into too much of the technical detail, what are the key things you would like to see improved about VCT rules?
I think there's two things, Alex. One is the investment limits, and whether it's an annual of 5 or a lifetime of 12 million. These limits were set in 2016, and they haven't changed since. So we've had about 35% inflation since. If we don't do something about it soon, we'll get to 50%, which means that we're effectively, VCTs are only able to invest half as much as they were 10 years ago into these high growth businesses that need the cash. We've also seen that the business models that are coming to the market nowadays, especially the tech ones, require more cash and for longer. Biosciences, life sciences, deep tech, all require lots of cash. So we need to work with the government to try and increase these limits, to reset them back to where they were. And the other one is age limits as well. There's certain limits around companies being no more than 7 or 10 years old. It's quite arbitrary, really. There should be no date by which, before which you need to have a good idea. Good ideas can happen at any time, and we should be able to back businesses with that new idea to keep growing.
Okay, Paul, obviously Octopus, I'm sure they have a lot to do with lobbying government, etc. What would you really like to improve about the VCT, if anything?
I mean, I think with the recent extension of the Sunset Clause, there is an element of stability, which is now coming into the VCT ecosystem, which I think, really the current government has rubber-stamped the work of the previous government in terms of extending it. From our perspective, I think because we do like to try and follow and invest later stage, we do sometimes come up against that limitation on how much capital a company can raise. And also that does sometimes inhibit the ability for that business to grow, right? Because if it needs a certain amount of money to go after a certain type of opportunity, we can only provide so much to that company. So I would certainly agree with Chris that I think there has to be we have to revisit some of these annual limits, some of the lifetime limits to cater for the fact that if we really want to build huge companies in the UK and try and follow them over the longer term, we are going to need to be able to invest in those later stages of growth.
I think business model's another element of it. One of the things that we're starting to see, and it really is the beginning with AI, is that you can take a business that's historically been quite Luddite, that hasn't used tech. You can actually buy a business as a go-to-market strategy and dog food the tech in Doing that is a problem in the VCT rules because of the age limit. But it's a really legitimate go-to-market strategy for markets that are not very tech-enabled, which is where we want to see the growth in the UK. And VCTs are a little bit hamstrung there. It's possible at times, but it's difficult. It makes tech-enabled services a difficult area to invest. And it is probably going to be one of the biggest growth areas in the age of AI. So we probably do need to address particularly that point as we come into this new sort of paradigm.
I think we all agreed it's a good scheme, but because of history, it needs updating, so it's fit for the next, certainly 10 years, if not longer.
Yeah.
Yeah, I would just be cautious on that, in that I think VCTs now, as opposed to 10 years ago, are investing in the right sectors. They are investing in the right companies. The capital's being channeled to young, exciting, growth stage businesses. So we just need to be mindful not to throw the baby out with the bathwater, I think, with any updates that are being done.
Okay, and finally, and I'll start with you, Paul. From an investor's point of view, why should they invest in VCTs?
Well, I think VCTs are unique. It's very hard to gain access to exciting, young, early stage companies that are making such a massive impact on the UK's innovation agenda, and potentially could be the next Amazon, Uber, or Facebook. Right? That is an amazingly exciting thing for any investor to become a part of. And I also think where the market is at the moment, I think this is a good opportunity to invest. I think the macroeconomic climate has stabilized somewhat, and I think you can therefore have a lot more confidence with how you make an investment in an early stage company over the next five plus years.
Seb?
Yeah, I think on that, the NAV stability that you've seen, and as you said, going sideways, that's actually a good indication that things are. It's a relatively good time to be looking at investing. A VCT is unique in many ways because EIS is its partner scheme in some ways. But in EIS, you take much more individual company risk, and that has a clearly commensurate investment return. VCTs give you more diversification, which enables you to get that access that you're talking about, Paul, but you get it in a way that is mitigated. It's not no risk, of course, it's still high risk, but it's mitigated risk because of the diversity and getting a dividend off that as well, and the tax relief too. It's a particularly attractive scheme, I think, to somebody who wants to add this into their portfolio of investments.
I agree with that. I think VCTs have become now a mainstream part of any investor's asset allocation. At the beginning, the VCTs were very much a sort of cottage industry. Nowadays, it's a £6 billion industry. It's a mainstream asset allocation investment decision that people make every year. And I think the sheer choice of VCTs out there reflects on a buoyant market. So I think with taking the Seb's point on the portfolio aspects of VCTs is key. As you invest, you can gain immediate exposure to 40, 50 existing companies. So if you do 2 VCTs, you'll have spread your risk over 100 companies. I think that's well worth thinking about for today's investors when the tax efficient space is being gradually eroded because pensions are more difficult. We still have ISAs, but everything else is a bit more difficult to get a government-sponsored tax scheme.
Well, thank you very much, Paul, Seb and Chris. It's been a very interesting conversation, and it's been great to have you all here. Thank you very much.
Thank you, Alex.
Yeah.
Thank you,
Thanks, guys.
Thank you.
If you're watching on YouTube, please press like and subscribe to the channel for more.